Hi there, I'm Darren McDermott, bringing you this update on the RBA with Stan Shamu, a market analyst at IG Markets in Melbourne. So Stan, the RBA today said in its meeting minutes that the bank should neither close off the possibility of reducing rates further, nor actually signal an imminent intention to reduce rates further. Now, the course of the exchange rate would be important, they said. So how do you feel about the comments made? And of course, do you think we will actually see a cut in September?
Yeah, well, I think they've really found a balance between a hawkish and dovish stance today, and that really has been a very neutral reaction by the market to the minutes. I think that the key takeaway is the fact that they effectively balanced out the fact that there's no imminent cut with the possibility of further easing in the future, not quite closed off. So that was very neutral by them, and I suppose it really just shows that perhaps they are content with the way things are at the moment, and they will take a wait-and-see approach, which is how we're taking the situation. And of course, the fact that they said it's not, they're not looking at an imminent cut, is possibly a little bit more hawkish than what the market was priced in for. I think the market was actually hoping to see back-to-back cuts after last month's cut, after this month's cut, that is, and this might have slightly disappointed some of the bears out there.
And the minutes showed that the Australian dollar had declined since the previous meeting, though it remained high by historical standards, and it was actually possible that the exchange rate would decline further over time. So what do you think about this?
There's certainly potential for further falls in the Aussie dollar. Just immediately after the minutes, I think the Aussie dollar lost a little bit of ground, but it wasn't really only about the RBA minutes, so we wouldn't really attribute today's weakness in the Aussie dollar to that. And it's more of sort of global macroeconomic issues that have weighed on the Aussie dollar. But we do still feel that there might be a bit of short-term strength in the Aussie dollar, mainly because the fundamentals for the local economy have slightly improved. And if the RBA takes a wait-and-see approach from now heading into the end of the year, then this will probably actually lift the Aussie dollar a little bit. But we do think around the 93-cent level is where the sellers will start coming in, and we'll probably see a bit of normalization around that 90-cent level. But if we do get another cut, then this would probably see the Aussie dollar then trade below that 90-cent level heading to the end of the year. But at the moment, it doesn't look like they're in any rush to cut. So the Aussie dollar is probably going to see a little bit of stability just above that 90 cents level.
And despite the reduction in the growth forecast, we have seen a pickup in housing as they climb by the most in more than 3 years in the second quarter. And of course, consumer confidence rose 3.5% this month after the RBA's latest rate cut. So do you think we will continue to see house prices rise?
Yeah, absolutely. It does seem like the recent cuts are now starting to filter through to quite a number of sectors around the economy. In Australia, I think housing is the core value for a lot of families, which actually holds the primary wealth. So it is important for the RBA to continue to help underpin the housing market. Now, with the housing prices, we actually have seen a marked improvement, particularly with auction clearance rates, where we have seen a marked improvement or marked rise in the participation as well. So it does certainly look like there is confidence coming back to the market. And when you find a lot of home values going up, then essentially this also boosts the confidence that investors have to go out there and spend money. And of course, once construction starts picking up as well, it means those new home sales will start ticking higher. And of course, ultimately, it will lift the rest of the economy. So we are really looking at this housing market recovery as a source for signs of economic improvement in Australia.
And before we finish, Dan, what other important factors should we be watching out for?
Yeah, absolutely. I think we have to keep a close eye on China. Of course, Australia is highly leveraged to China, and of course, how China performs has been a very good bellwether of how the Australian market is going to go. Of course, we've got a very big mining and resource base in Australia. And as long as these miners are continuing to tick along, particularly as we've seen iron ore start to rise again, and of course, if we see a marked improvement in other commodities, then this should be fairly positive for Australia going into next year. Of course, the mining cycle is very important because mining investment also filters through to the rest of the economy. So that's probably a big factor to look out for. China has been implementing a few changes recently with a new government in place. So that might have a few teething issues for now. But once this gains momentum and traction, then we do expect it to start lifting the Australian economy. And this will be ultimately positive in the medium to long term.
Thanks, Stan, for that. Well, viewers, do stay tuned as I'm also looking at the emerging market slump today. So do have a look at this interview too. But for now, goodbye.